Welcome to this video series about measuring value creation in private equity, where we show you the easiest and most accurate ways to measure equity value creation in private equity deals. My name is Mike Reinhardt. I've worked in the industry for over 15 years. I wrote the book Private Equity Value Creation Analysis, and I run the AUXILIA Mathematica and ValueBridge.net websites. These videos cover findings from my work, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it is helpful to you, subscribe and check out the website where you can download Excel files behind every episode. This is video number 15 in the value creation series, and it is a good spot to stop, take stock, and summarize where we have been. It took us 14 episodes and more than 3 hours, but we have now covered every major value creation equation. These include capital structure value drivers like fund ownership impact, the leverage effect, and gearing. They include the impact of broader market forces like addressable market growth and market multiple expansion. And they include value drivers that measure sales or operational improvements like market share growth, gross margin expansion, and operating margin reduction, which might be attributed to investment manager skill or GP value add. In this video, we will review every equation behind this chart. Now, the reason it took us 3 hours to cover everything is that we spent a lot of time deriving the mathematics, showing you how to convert back and forth between the 5 different measurements of value creation, and also proving that these models work better than other approaches in the academic and industry literature. In the next few videos, we'll turn from theory to application. We'll talk about where you get the model inputs, how to handle holding period events like add-on acquisitions and dividend recapitalizations. We'll cover common mistakes made by GPs and LPs so that you can avoid them, and we'll modify the framework to solve interesting real-world problems like quantifying the equity value impact of ESG initiatives. Now, before we move on, I would like to introduce an option for analysts who don't have 5 hours to watch YouTube or the inclination to read my 250-page math book. ValueBridge.net is a new website designed to help analysts build private equity return models immediately. It is different from AUXILIA Mathematica in that we skip all the academic theories and mathematical proofs and give you just what you need to build the chart, make sure that it's correct, and then plug it into your investor presentation. ValueBridge.net breaks everything down into 40 efficient modules. You can filter by topic or value driver to find the one that best fits your application. Every module includes a Microsoft Excel template that includes one tab for a buyout deal and another for a growth equity deal, so they can be used with very little modification. Each module also includes a short instructional video, one that shows you exactly how to do the math with step-by-step examples. And finally, each module includes an interactive online value creation calculator where you can plug in the numbers for a portfolio company to make sure that your Excel model is giving you the right answers. Check it out and subscribe today at ValueBridge.net. With that, let us summarize all the value creation equations. Here in the derivative model, we start with a change in a GP or fund's equity value, which we call FEC-V. Total shareholder equity value is TEC-V, and it gives us the fund's ownership percentage, which is FEC-V divided by TEC-V. This allows us to calculate a hypothetical dilution-neutral return called the isomeric return. It's equal to the change in total equity value times the average holding period ownership percentage, and fund ownership impact, which is the equity value change driven by dilution or concentration. It's equal to the change in ownership percentage times the average holding period total equity valuation. The next independent variable is net debt. It allows us to calculate the total enterprise valuation TEV, equity ratio ER, and debt ratio DR. The enterprise valuation and equity ratio give us the unlevered return and the leverage effect. The latter is driven by 2 factors, debt or excess cash on the balance sheet and changes in debt or excess cash on the balance sheet. Using the net debt and the debt ratio, we can break the leverage effect into cash flow generation and gearing. Cash flow generation represents debt that was paid down with company cash flows, cash that was accumulated on the company's balance sheet, or cash that was burned to fund the company's growth initiatives. Gearing measures the influence of average debt or cash on the equity return. In a levered deal, debt makes equity value change faster than enterprise value, so gearing tells us how much debt has amplified the equity gains and losses. However, in a growth deal, excess cash makes the equity value change more slowly than the enterprise valuation, so gearing tells us how much cash on the balance sheet has dampened equity gains and losses. While we're over here on the capital structure side, we can introduce the sector debt ratio, or SDR. It's a leverage benchmark that represents a capital structure for the typical sector peer, and it also gives us the excess debt ratio, or XDR. This allows us to break gearing into sector gearing, which is the gearing that would have occurred if the company had as much debt or cash as the typical sector peer, and excess gearing, which is the extra gearing that occurred because the company had a different capital structure. That covers all the capital structure components, so let's go back to the unlevered return. Now, because this value driver has already been unlevered using the company's average holding period equity ratio, everything that comes after it will also be unlevered. And that means that you can use these equations to compare value drivers like EBITDA growth and EBITDA margin expansion, even when companies have very different capital structures. It won't matter if some of the investments are growth deals and others are LBOs, because the equations are normalized for the different leveraged levels. Alright, next we introduce the trailing 12-month EBITDA, or E, which gives us the company's EBITDA valuation multiple and the value drivers for EBITDA growth and multiple expansion. Then we introduce the TTM revenue, or R, which gives us the company's EBITDA margin and the value drivers for revenue growth and EBITDA margin expansion. Then we introduce the company's TTM gross profit. This gives us two P&L ratios: the gross profit margin, GM, and the operating expense margin, OM, which is the company's SG&A divided by its revenue for a period. This is just equal to GM minus EM, and the margins allow us to calculate equity value creation driven by gross margin expansion and operating margin reduction. Next, if we have a good measurement of a company's addressable market, AM, we can use it to calculate market share and measure the equity value creation driven by addressable market growth and market share growth. And if we have a good set of market valuation data, we can plug in market multiples, or MM, to calculate mu, which is the company's valuation discount or premium. This gives us equity value creation driven by market multiple expansion and intrinsic multiple expansion. The latter can measure the impact of a company's valuation outperforming the broader market trend, and it might come from buying below market, selling to a strategic buyer, or materially improving the quality of a company's revenue and earnings. Now, finally, we can combine these value drivers in any way that we wish. So we can add up value drivers like addressable market growth, market multiple expansion, and sector gearing and call that the market-driven return, and then assign the rest of the value drivers to the manager-driven return. Now, I know that we went through all that math quickly, but you'll find all these formulas on the episode page along with Excel templates that show you how to use them. On the site, we'll also provide links to the episode pages that prove the mathematics. One thing to emphasize here is how computationally efficient these models can be. There are 21 different value creation measurements on this chart, but they're calculated from only 9 numbers. These are the independent variables, and if you set up your spreadsheets correctly, as we do with our Excel templates, these are the only numbers that you need to change when you update your model at the end of the quarter. 6 of them come from the company's capital structure and P&L. And look what they are: fund equity, total equity, and net debt, and then revenue, gross profit, and EBITDA. These are numbers that are often found on portfolio company one-pagers in a GP's marketing deck or in a fund's quarterly report. And then you have the market data points. GPs and LPs talk about market multiples all the time, so there's plenty of sources for that. Addressable market changes can come from industry reports or economic data, and sector debt ratios can be estimated from something like Capital IQ or even Yahoo Finance. Unlike the other academic and industry models that require detailed portfolio cash flows and other proprietary data, you might be able to build this model without ever making a special data request to a private equity GP or deal team. Alright, that was a derivative model. Now let's do the same with a logarithmic model. Here we have all the same inputs as in the first video, but instead of measuring value creation in dollars, we use equity return multipliers. The fundamental unit of value creation is a deal's gross multiple of invested capital, or the GP or fund's equity value at time 2 divided by the value at time 1. This is a different way to measure equity value changes, but it is a completely valid method that will give you nearly identical results. The isomeric return is driven by the change in total shareholder equity, while fund ownership impact is driven by the change in the GP or fund's share of equity. The unlevered return is driven by the change in enterprise valuation, while the leverage effect is driven by the change in the equity ratio. EBITDA growth is driven by the change in TTM EBITDA, while multiple expansion is driven by change in the valuation multiple. Market multiple expansion is driven by change in the market multiple, while intrinsic multiple expansion is driven by change in the company's relative discount or premium to the market valuation. Revenue growth is driven by the change in revenue, while EBITDA margin expansion is driven by change in the EBITDA margin. And addressable market growth is driven by the change in the addressable market, while market share growth is driven by change in the market share. Now, this intuitive pattern breaks for the remaining value drivers because the underlying components are related to one another by addition and subtraction rather than by multiplication and division. But it's not difficult to work with them on an Excel spreadsheet. Gross margin expansion and operating margin reduction are both equal to the EBITDA margin expansion equity return multiplier, but raised to the power of a fraction. The first is the gross profit margin change divided by the EBITDA margin change, and the second is minus the operating expense margin change divided by the EBITDA margin change. We have a similar setup over here on the right where cash flow generation and gearing are both equal to the leverage effect equity return multiplier raised to the power of a different fraction. Cash flow generation has net debt in the numerator, and gearing has total enterprise valuation change in the average holding period debt ratio in the numerator. And then we split up gearing into sector gearing and excess gearing. We keep the same format as the parent, except we swap out the company's debt ratio with either the sector debt ratio or the excess debt ratio. Now, just like with the derivative model, we can also combine value drivers to measure a market-driven return and a manager-driven return. The difference is that the value drivers are related to one another with multiplication and division. So the market-driven return would be the product of addressable market growth, market multiple expansion, and sector gearing, and the manager-driven return would be the gross multiple of invested capital divided by this value. Again, that was a really quick overview, but we show you all the math and all the variables on the AUXILIA Mathematica episode page. So, if you're into this sort of thing, please like, subscribe, check out all the private equity value creation videos on the website. Registration is free and gives you full access to downloadable Microsoft Excel templates, articles, white papers, online value creation calculators, and other content. And don't forget, also check out valuebridge.net if you want a paint-by-numbers guide to building these models. Thanks for watching. I hope to see you either at AUXILIA Mathematica or valuebridge.net.